All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker DIS, Disney, the Walt Disney Company. Very well-known company, and we've covered it a couple times on the channel before. We've also owned it in the past before, not currently a shareholder of it, but I think I was still a shareholder of it, I believe, last year when I was valuing it. I believe that was when I made the decision to get out of it, or maybe I got out of it a little bit before doing that revaluation. I can't remember. But anyway, I digress. I'm pretty excited to get into this valuation today. I put together, I think, a pretty sophisticated and well put together model of projections of where I think that they can go in the future, both for their revenues and their subscriber growth of their direct-to-consumer business, as well as the other sections of the business. And we'll get into the breakdown of all that in a little bit. Coming over here to take a look at our portfolio watch list and taking a look at all of the valuation stuff in here and getting an idea of what we've done in the week. This week I bought a little bit more of Smith & Wesson. That was really one of the only major purchases I made this week, as well as a little bit more of F&G, which is the company that, as I mentioned in our last stream, is not actually in our watch list. I haven't done a full evaluation of them, but they were a spinoff of my main holding, my largest holding, Fidelity National Financial, which I do have valuations on. And so I've been buying up a little bit of that as it is a spinoff of it, and I don't have as much of exposure to that particular section of the business, and so that's a good opportunity for me, along with Smith & Wesson, like I said. I also been selling out of a few other positions and just kind of getting my portfolio prepared for this overall pretty exciting week that we were expecting. We obviously had the consumer price index, the CPI inflation print came out this week, this morning, which I'll get into in just a moment. And then we're also expecting the Federal Reserve monetary policy decision from the FOMC tomorrow. Jerome Powell coming out to give us the decision about whether or not we're going to be having a 50 basis point or a 75 basis point interest rate hike again tomorrow. So looking here at the watch list, there hasn't necessarily been too much exciting movements in the actual watch list specifically. I have noticed a couple of companies moving up and down a little bit relative to each other. In particular, that they're used to have Paramount and AMC networks both relatively high up in here, and Paramount is seemingly come down a little bit relatively to AMC. I'm not sure if maybe my assumptions for both of those need to be adjusted, but I have been kind of hoping to maybe take a little bit of a closer look at both of those companies, since they're also in the entertainment sector. I am trying to do a little bit more of a deep dive in the streaming companies to get a better idea of what's going on with them. A lot of them aren't necessarily the best of values, but it's either way an industry that I like to keep close focus on, which is relevant to the one that we're talking about here today. But getting into also the CPI information, which, as I said, came out today. We had the consumer price index report today, and it came out that the overall headline number for the CPI index came out at 7.1%, which was about 0.2% cooler than was expected. The 7.3% was what was expected. My own prediction for the CPI number was relatively in line with the economists' expectations, and so it was a cooler than expected number, not only for the economists in general, but for my own expectations as well. And obviously, the upward movement in the market today is a pretty obvious sign that the market is pretty pleased with that number. But I did want to get into the specifics of the categories to break down some of the specifics of what I see within this report. So what I have right here is the 12-month rolling number for each of the categories here on the right, and I have highlighted in yellow specifically the numbers that are currently above the headline print number of the 7.1 that we have here at the top. So 10.6 for the food category, 13.1 for energy, 14.2 for energy services, and so on and so forth. And if it has a yellow bar next to it, that basically means that those subcategories within it are both hotter than the overall number, but I didn't highlight them since they're part of that, the number above. But so you can see that basically a huge portion of the categories on the 12-month number appears to be hotter than expected. However, if you look a little bit more closely at specifically the month that just came out, the November month, and simply the month over month changes, and if we then highlight the ones that annualize up to at least 7.1%, which means taking this number and compounding it up over 12 times, and then you can see that actually only two categories are hotter than expected on the most recent month print. Those categories being fuel oil, which did have a very large sharp upward spike in October of almost 20%, and the annualized number is up over 66%. So either way, if we could get it back down to just 1 is 2% per month, which would annualize up to like 12 to 15%, that would be so much better. But then the shelter is also a little bit hotter at 0.06, which the shelter category is one that's interesting to note because it's one that I've talked about a lot as being some of my more pessimistic takes on the CPI that I've given out this year was that even though I saw the potential for the other categories to start cooling down, my concern was that the services, and in particular shelter services, was going to tick up throughout the year. And that story seemed to play out pretty solidly up through October of last month. And then suddenly we get a downward month this month, which seems to belie the story that I was painting with that. However, we did also have a cooler than expected number or cooler than previously number back in July. So that's not to say that you can't usually have a little bit of a bounce back in that overall adjustment of the shelter numbers. But the point is either way, even though this is still hotter than the 7.1 number, it's still cooler than it was in October, which is maybe an indication that even the shelter numbers are going to start to come down in the near future. So this is a long way to say that this is a pretty dang good CPI report, I gotta say. I mean, not good, but it's much better than the last few CPI reports. It's much better than was expected across the board. There's not really too much you can really quibble with down in the details here, other than to say fuel oil very well might continue to spike into the winter. It's possible the electricity will also have to spike a little bit into winter. And like I said, shelter prices may not actually be coming down in the short term. It's also worth noting you can also maybe make some small other quibbles to know that, for example, if you look very closely at which categories have received 0 downward price movements, there's not a lot of them. Specifically, the 2 categories where there's 0 downward price movements on any of these month-over-month changes is specifically shelter and food, which is 2, super necessary categories. So it's not exactly what you would like to see for areas where there's literally 0 downward movements. So it's like, yeah, we're having some significant downward movements in things like gasoline, as well as used car prices, which do have significant weight to them, and pipe utility oil, which also has significant weight to them. But shelter and food are obviously key things and factors to everybody's main expenses for their own lives. So that's enough of the CPI numbers that I wanted to get into. Just wanted to kind of get into some of the specific details of that. And then, as we already said, there is going to be the Federal Reserve announcement tomorrow, and I'm planning to do actually a special stream for that announcement starting at 11:45 my time here in Arizona, which equates to 1:45 Eastern time, which is the time that's relevant to their own announcement. So we will be going live at that time, which is 15 minutes before the announcement. So you can come and join us and hang out a little bit and chat, and we can take a look at tickers and go over some investment ideas and stuff like that. And then once the announcement comes out, we'll take a look at markets, see how the market's reacting to that stuff. And then 30 minutes later, when Jerome Powell comes out to make his announcement, we'll tune in and give that a listen, and then maybe hang out and listen and chat and look at more tickers and stuff after that for a little bit. So that's what the plan is tomorrow. So with that, we'll actually start getting into the actual valuation for Disney. I had to cover some of those little details before we actually hopped into it. But as the start with, as we do with a lot of our valuations, we'll just cover some basic company information as it currently stands for the company. They were founded in 1923. As I said, Disney, one of the most famous brands in the world, doesn't need a huge introduction. Part of the United States and on the New York Stock Exchange, with its currency reported in United States dollars. All of their main sites I have listed here. The current CEO is Bob Iger. He was recently remade CEO after the ousting of Bob Chapek, which made all the news headlines and was a big deal. Originally joined the company in 2013. Like I said, he was just recently re-elected to the CEO position here in 2022, though he was only recently left the position of CEO only 2 years prior to that. And he didn't even leave the company in the first place. He had actually remained on the board as the executive chairman of the board. So he still had substantial power within the company. In fact, I would argue he effectively strategically arranged for his own emplacement as CEO yet again. I think he was effectively still the man in control of Disney the whole time, even though maybe Bob Chapek was the spokesman for the time period. Obviously, being part of the entertainment industry, customers and suppliers are a bit too broad to really get into specifics of, but competitors, well, we can name lots of them. Netflix, Warner Brothers Discovery, obviously being 2 very large ones within the entertainment space. Comcast and Paramount, as well as even Apple, could also be listed here. You could also include Amazon. Basically, all the streaming players can be considered their competitors. You could also include other amusement park companies if you wanted to include some of their competitors, but that is, relatively speaking, not the lion's share of their business, so I didn't really include that part here. The next date that they're expected to report is on the 7th of February, and so presumably they're going to have their call at the same date or a day later. We're not sure exactly when the filing will be coming out on that. The guidance that they've given for their revenue in terms of the fiscal year 2023, according to the transcript that they had from that call, is high single-digit revenue growth and operating income growth is what they seem to be projecting. Nothing super specific. They're mostly focusing on just their subscriber growth and the projections for that. And then they do also give a lot more specific guidance in terms of the expenses that they expect to incur related to that growth of industry. Specifically, they talk about having about $30 billion worth of content cash spend in 2023, which they equate to being approximately equal to what they spent in this year, 2022. And then they're also expecting to do about $6.7 billion in cash capex for their parks, which kind of gets into the fact that they have it disaggregated by these two sections. It gets into discussion of really the two forms of capital expenditures that they have and how that relates to the two types of their business, which we'll get into a little bit when we take a look at their earnings report and a little bit of their 10K. The analysts, according to Yahoo, project $90.64 billion as the revenue for 2023, according to 21 analysts, and then they're projecting $97.24 billion according to 20 analysts for 2024. And then that also comes out to be $4.13 in adjusted EPS, according to 21 analysts for the EPS in 2023, and then $5.32 according to 20 analysts in 2024. They're currently not paying a cash dividend either in the most recent year or in the forward year. They did cancel their dividend back in 2019 to focus on the growth of their DTC business, and they don't have any share buybacks authorized either. They're focused entirely on putting cash flows in the business. We did just talk about massive amounts of capital spending, either in OPEX spending or CAPEX spending format for the growth of their business. The percent of their business held by insiders is pretty minuscule at 0.11%. However, it was increased pretty dramatically by about 58 to 59, almost 60% in the most recent 6 months, which is basically Bob Iger buying back into the business as he is now CEO. So it is good to see Bob Iger back as CEO, both because he is a renowned figure and presumably a great executive as his tenure in the past has shown, but also he's putting his money where his mouth is. So that's always good to see. Shares are held by the institution, about 65% of the company. There is currently about 1% being shorted at the outstanding, and the short percentage of float is roughly equivalent to that. The short ratio being less than 1 day, so there isn't really too much a leverage in the short hands to be speaking of, or against the short hands to be speaking of. The average volume for the last 3 months has been 13.33 million versus 12 million or so in the last 10 days. So the volumes have been a little bit more relaxed in the last couple of weeks relative to the last few months. So you could argue that this would maybe be a good time to get good pricing if one was interested in buying, if one did find it to be a good value. Spoiler alert, I don't find them to be a very good value. So anyway, coming over to the earnings call, we'll take a brief overview of some of the segment results and details as they kind of describe it here. I'll kind of like briefly read the little paragraph that I do as the kind of summary by Bob Chapek. 2022 was a strong year for Disney with some of our best storytelling yet. Record results for parks, experience, and products. Outstanding subscriber growth, which added nearly 57 million subscriptions this year for a total of 235 million subscriptions. That's across all their platforms, not just Disney Plus. That's including the ESPN and just all the general platforms. Our fourth quarter subscription growth, they got 14.6 million total subscriptions, including 12.1 specifically from the Disney Plus. That's rapid growth in just 3 years, a result of their strategic decisioning, investing heavily in creating, which, as I just said, massive investments in it. They expect their DTC operating losses to narrow going forward, and that Disney Plus will achieve profitability in fiscal 2024, assuming we do not see a meaningful shift in the economic climate. You always gotta not like that last part where they're like assuming not a meaningful shift in the economic climate. But regardless, I'm not super focused on necessarily where the Disney Plus profitability comes in specifically as a segment, because I'm kind of thinking of the business more as a total operating unit. You'll see how I think about all that when we get to my projections. But regardless, they're expecting to get better profitability moving forward, which is good for them. We'll get into that when it relates specifically to the actions that they're taking. But coming down here to take a look at the actual segments that they have. The way that Disney currently segments their business is Disney Media and Entertainment Distribution, and then they also have Disney Parks, Experiences, and Products. This is something I've kind of complained about. Anybody who's been paying attention to Disney for the last several years, they've changed their segment format literally twice in the last 4 years, which is really, really frustrating for somebody who wants to go through all the numbers and try to analyze the company on a segment basis, because you basically have to like rearrange different segments being aligned with each other, whether the networks are being tied in with the studios, or the parks are being tied in with the products, or DTC is being tied in with any or either of those. They currently have these 2 segments. In the past, they've had 3 segments. In other sections of time, they've had 4 or 5 segments. For my projections, I basically went back through and then kind of reanalyzed all of the segments into my own custom groupings. But regardless, here they show that as you can see, on the year end, they have media and entertainment growing at 8%, whereas parks and experiences growing at 73%. So obviously, parks and experiences were closed for the most part. Obviously, some of the parts of their business are still having difficulty getting open in the Asia section of the world, but they did massively open that up in this particular year, and they still had significant growth in entertainment. And that's worth noting because, you know, like there's this whole concept where the idea is that the direct consumer portion of their business is going to cannibalize the other portions of their business, the entertainment portions of their business. And I'm going to say that that's not necessarily holding up if you look closely at the numbers. We'll get into that much more specifically in a little bit. Breaking it down into these subsections, they show how the linear networks grew 1% on the year, while direct consumer grew 20% on the year, and then the content sales, which includes a lot of the studio stuff, grew 11%. So you can see that even the studios were growing while the direct to consumer was growing, when theoretically the direct consumer is supposed to be cannibalizing the studio portion of their business. But this is partially part of the bounce back from the low studio sales in 2020. But either way, it wasn't as bad of a bounce back from 2021 as the parks had to do. And then also coming down to the other section of their business, getting into specifically the Disney Plus section of the business, we can see the growth of the subscribers, 20% growth for Disney Plus on the whole of it. Total Disney Plus about 39%, so for including Disney Plus Core and Hotstar, which includes other sections of the globe. And then there's also a 42% growth in ESPN Plus. Total Hulu growing 8%. So again, 235 being the combined total of all of their subs, a significant growth on the year. However, we do actually have a decline, generally speaking, depending on the category, in the average monthly revenue paid per subscriber. This has to do partially with the fact that they didn't raise their prices this year. They actually are about to raise their prices at the end of this year, or at the start of next year. I believe it goes into effect at the end of January. They're going to be raising the US Disney Plus price from $7.99 per month to $10.99 per month. So that's going to be a significant jump in their overall revenue, assuming no subscriber change. Obviously, there's going to be some subscribers that are going to fall off of that, and we don't know what the percentage is going to be for that. It'll be some significant chunk. And then they're also planning to unveil their ad tier at somewhat of a similar time, which means that some of those people might shift to the ad tier, some of them might drop off entirely, and then we'll have to see what the balance on the mix shift over is. But theoretically, that will significantly increase the ARPU next year. It's just a question of how much that's going to affect the subscriber growth next year simultaneously. Coming down to take a look at the parks and experiences, as we kind of already noted more specifically, parks and experiences had a huge bounce back from when they have most of their operations still closed in 2021. 44% growth domestically, 55% internationally, and the consumer products also grew, but only about 4%. So the overall segment together growing at about 36%. So that's basically pretty much all the details that we're going to cover here in the quarterly earnings release that they have right here. I did want to cover a couple specific details from their 10K because that's going to relate to how we're going to think about the growth of their business. As they had kind of said that they had done in the last year about $30 billion worth of content spend, and then they had projected in their transcript that they were going to do $30 billion of content spend in the next year. Now, most people hear that and they're like, $30 billion worth of capital expenditure? Oh my gosh, their free cash flows are going to be destroyed. Well, the one thing you have to understand about Disney's DTC business is that their content spend is not something that ends up on their balance sheet. They're effectively just writing all of that expense off immediately as soon as they finish the project. So it shows here the content spend that they did in this most recent year, $10 billion or so monetized individually, with 21 to 22 monetized as a group, ending up about $32 billion overall content being produced and capitalized over the 2022. That's versus 25.5 billion or so in 2021. And again, they said they expect to do similar numbers next year as they did this year. And you're wondering, where do all those costs end up going exactly? Well, if we come up a little bit further in the 10K to the section where they are disaggregating the sections of their business by different portions of their revenue, here we are, the business segments. We can come down here and take a look at it. It shows, if we break down here to the Disney Media and Entertainment section of their business, they have the linear networks, direct consumer, and content sales licensing. If we come down here to take a look at the actual expenses, it shows programming and production costs for both cable and broadcasting. If we add those two together, we end up with about 12.2 billion. Add international channels and you end up with about 15 billion. So keep that number in mind, 15 billion. And then we come down to direct consumer, we end up with a similar line coming down to the content spend over here, 15.3 billion, added on to 14.1 right there. That ends up with 29.5 billion or so. And then again, that's just between those two sections. We also then would have to add on the production costs coming from the content sales or studio sales, which is further down right here. What was that, 26 billion we had before, 26 billion plus production costs of 4.2 billion. Boom, we're up to 31 billion or so, give or take a billion. I missed it or so. Now the point I'm doing of showing you where all these costs are is that all of these costs effectively end up in costs of goods. They effectively end up as part of the operating costs, not just the operating costs, but not even specifically operating, but unit costs, the cost of goods of the revenues, which means it's going to lower the long-term margins of the business, but it's going to also lower the overall capital invested in the business as a whole, which means it could up the potential returns on invested capital proportionally to that. So like I said, I have built a revenue model kind of specifically around the segments of the business, which we're going to get into shortly in a little bit. But before we do that, I'm going to cover the segmentation of the business and how that builds into the discount rate that I have for the company. I actually didn't pull the industrial grouping spreadsheets open. Let me go grab that real quick. My mistake, forgot to pull that one open. All right, so come over here. I already do have the right pages open. Entertainment and hotel gaming are the two sectors, portions of the business that they're a part of. Primarily, we're thinking of them as part of the entertainment business, but they do operate partially as the hotel gaming. Oh, here, hold on just a second. Let me, I have to, I'll let my cats out of the room real quick. Sorry, one of my cats had to get out of the room and the other one was trying to chase him down, so I need to deal with that. But anyway, so the unlevered beta for the entertainment business is 1.03, so that's going to be the beta that we're going to be assigning to them for the business. If you take a look at the sales capital ratio for the industry, you can see that the entertainment industry, typically speaking, has a relatively high sales capital ratio. With a sales capital ratio over 1, that means that they are effectively getting revenues of over $1 for each dollar of capital invested in the business. And then you can see the adjusted margins for that industry typically ends up being low or mid single digits at kind of a best within that range. You can also see that their gross margins typically are around the 40% range, and also the debt to equity ratios typically end up being in the 15s, maybe in the 20s at the higher end of the cycle. Hotel and gaming has a little bit of a different dynamics depending on it. And as we said, this is kind of a smaller section of Disney's business, more like 20 to 25% of their business, but it's something we want to take into account nonetheless. The margins of their business is much more cyclical, on average being pretty poor. However, if we go up a little bit further up the line, you can find that the operating margins typically are actually a little bit better, which has to do with the fact that there's going to be a lot more variability in the debt levels, and therefore the difference between operating margins and net margins for the hotel gaming industry. However, the hotel gaming industry does require much more capital expenditures, which is why they're going to have a much lower sales capital ratio. And I'm bringing that up specifically because Disney's going to look a lot like an entertainment business in a lot of ways. However, because of the massive amounts of capital expenditures that they have to do in the hotel and amusement park parts of their business, they're going to have a much lower sales capital ratio as a result, which unfortunately has a pretty detrimental effect on their overall value. So as I said, we're thinking of them primarily as an entertainment business. The unlevered beta for them is 1.03. The sales capital ratio for that industry is 1.32, even though they're going to have a much lower sales capital ratio for Disney specifically. And the adjusted net margins on average is going to be about 9% or so, which typically speaking, traditionally, Disney had much higher margins than that, which would kind of balance out with the fact that they would have a low sales capital ratio. However, the DTC portion of their business, Disney Plus, is changing things. And it's kind of changing things a little bit for the worse in that particular perspective, because they actually end up with lower margins, but still a really low sales capital ratio as a result, which unfortunately does pretty bad damage to their overall value as a whole. Now, they also have a distribution of their revenues within their 10K. About 80 to 82% comes from the Americas, about 8% coming from Asia, and 10% coming from Europe. That's the revenues. And then a somewhat similar distribution geographically for their assets. That brings their overall equity risk premium up to 6.28%, which their unlevered beta of 1.03 is then multiplied up to 1.22 based off of the debt to equity ratio of about 30%, which you'll note the debt to equity ratio is a little bit higher than the industrial expectations that we saw for them, both according to entertainment, but also it puts them roughly in line with what they are with hotel gaming. So not only do they have capital expenditures similar to hotel and gaming, but they also have debt levels similar to hotels and gaming, even though they end up with margins much more similar to the entertainment industry, which is not exactly what you would like to see. So anyway, the levered beta of 1.22 brings their cost of equity up to 11.27%. Now, they have about $54 billion in total debt, including their lease liabilities, and that's at a weighted average maturity of 5 years and an interest rate of around 4%, which brings their cost of capital to 9% for the company. 9% cost of capital is pretty high. It's not the highest thing in the world, but for cost of capital, that's pretty high. Like, you would hope that maybe that was more like your cost of equity, not your cost of capital. So that's definitely going to be a little bit tricky for creating value, effectively speaking, because you're going to have to take on projects that are going to do better than that. So now, if we take a look at their historic growth, their historic period, we have their years from 2013 up through 2022. You can see that their growth of the revenues went from 45 billion up to almost 83 billion in the most recent year. While their cost of goods sold has grown pretty precipitously as well, and we actually have a pretty significant changeover in their gross margins, which is something very, very important that we need to point out, and that's going to have a pretty big impact on the projections we make for the company. You can see that their gross margins up through 2018 was pretty consistently around this kind of 45% range. It varied a little bit, but pretty much about 45% consistently. And then it drops down to 39.5% in 2019, and dropping even lower in 2022, but then recovering a little bit in 2022. Now, that's a pretty large drop to go from 45% to an average for over these 4 years of 35%. And then you could maybe just say the most recent 3 years, then that would bring the average even lower down to 33%. And then you could think maybe 34% if it was the most recent year. So a huge drop. That's like a 10% drop in gross margins when they started doing their direct to consumer business, because that's exactly when that period started, is 2019. So I don't think that that's a coincidence. It's like that's a direct result of them changing the format of their business. It didn't the drop down to 33% had partially to do with COVID. So perhaps 2021 and 2022 is a better measure of what that average is going to look like. Maybe it's going to be 34%, but 34% is still way less than 45%. It's 11% less, in fact. So that's something we need to take into account. Now, we can also take a look at the kind of the same thing in terms of the operating margin. The operating margin up through 2018 averaged about 24%. 24%, which is much stronger than the operating margins both of the entertainment industry and the hotel gaming industry. So you'll see, like, they had killer margins prior to the direct-to-consumer business. However, they obviously didn't have the greatest growth. So that was kind of where the things were going to bounce off. Now, 2019, their margins dropped down to 17%, a huge drop, but not as bad. And then it dropped even more precipitously down to single digits. Now here we are in kind of single digits range. They've got it back up to 8% in 2022. If we use 8% maybe as a guideline, it's like that's still a huge drop. That's 2/3 of your operating margins lost. So that's just something that has to be taken into account. Coming down to the net margins, we can see a much similar pattern. Net margins up through 2018 averaged about 16 to 17%, and the net margin since then has averaged about 4 to 5%, and that's still including the 15 to 16% we had in 2019. If we just look at 2022 and 2021, the average has been 3.5%. Now, the assumption again is that they're going to be more profitable in DTC in the future, so this 3% may not be super representative of the real future. But what do we actually see as the real new guideline here? That's the difficult part. As we saw in our industry data set, the average margin over the long run for entertainment has been 9 to 10%. So do we assume that they can get back up to 9 to 10% maybe? Is that what we think? It's hard to say. That's a good guideline. I have my own ways of estimating the numbers, which we'll get into in a little bit. Coming down to the cash flows to take a look at it, this is where things get a little bit tricky, especially considering some of the specifics that the company has projected for what they're planning to give us in terms of like what they're telling us they're going to do in the future, and comparing that to what they've done in the past. There's some discrepancies, and so it leaves a little uncertainty of what I think is likely to happen. Specifically, If we take a look at the overall adjusted net capex number, which is a number that I like to use as a total combined number of all forms of reinvestment, it basically takes capital expenditure, it subtracts out all of the depreciation and amortization, it includes all the investment in working capital that has to be done, and then also includes acquisitions if those are done for the company, and boils it all into one full number to get an idea of just how much of the earnings is being reinvested in the business. And we end up with this number here as the adjusted net capex line. If we look at that over the kind of average of the 10-year period that we're looking at, the average amount for that number ends up being $3 billion. Which happens to be approximately the same amount that they did here in 2022. So on average, 2022 was a pretty typical year as far as reinvestment for Disney goes compared to the last 10 years. Now you can see in some of these years we have pretty large spikes up to numbers. It actually spiked up to almost 20 billion in 2019, but that's also when they had done a $10 billion acquisition within that year, and they'd also done $9 billion in working capital expenditures right then and there. So that was a crazy outlier of year for 2019. Which does have a huge effect on the outlier of that particular number. In fact, I did a little bit of a side little piece trying to get an idea of what the average would be like if we didn't include the acquisitions, because the acquisitions had such a large effect on the outlier itself. And so, for example, if we tried to get an idea of just how big of an effect the acquisitions actually had and subtract out those two, then it actually becomes clear that acquisitions maybe made about a $500 million per year difference across this entire time frame. So maybe if it's $3 billion is the average, it might have been $2.5 billion without all the acquisitions, at which point you could argue that 2022 was maybe a little bit more of an expensive year. But anyway, so getting into the discrepancies between what they say they're going to do versus what I think they might do, as I was kind of just saying, is that they say, according to their transcript, that they plan to do $6.7 billion in capex this next year. They in this last year did about $5 billion in capital expenditures, and then as that means that they're going to be doing a significant increase in capital expenditures, and then that has to be balanced out by the fact that there's going to be an increase in depreciation and amortization. Presumably there'll be a little bit less movements of working capital, but the point is if they're going to do $6.7 billion in cash capital expenditures, then that says to me that there would have to be a precipitous increase in overall reinvestment. Which doesn't seem to back up with the fact that they're trying to become more profitable within the next year or two. It sounds like they say they want to become more profitable, but that they also want to do more capital expenditures. Those capital expenditures might be good for growth, but it doesn't necessarily sound like they're keeping in line with that. So I'm not 100% sure what to think about that. And if we also take a look at how post reinvestment, they also have to issue debt, perhaps to finance a significant portion of this. Over the 10-year time frame, they've issued about $1.8 billion per year in debt. So that has had a huge impact upwardly on the availability of cash to pay out to shareholders in the form of free cash flows to equity. Effectively speaking, they would have $1.8 billion left on any given particular period. And if we look at, for example, the first 5 years of the free cash flows to equity, they had $8.8 to $8.9 billion they could pay out to shareholders, and the amount that came from debt was $2.4 billion worth. And the amount that they did pay out to their shareholders was $8.4 billion. So they didn't overpay to their shareholders, but it did use debt money in order to pay their shareholders that money. The next 5-year period, the amount of money that they could have paid out to their shareholders was only $1.9 billion per year. The amount that they did pay out to their shareholders was only $1.8 billion. So they've actually done a good job of not overpaying their shareholders. But again, that not overpaying the shareholders has been at the expense of taking on debt. And you can see also in the most recent 2 years, they've been paying down their debt. So perhaps that this is a little bit of a reversal that's starting to occur. However, those 2 negative years with negative debt prepayment did have negative free cash flows to equity, which means that they did have to pay it, effectively speaking, out of their assets or out of the cash that they had on hand. So they are starting to pay down their debt, but that's not necessarily because they have a huge excess of cash flows currently. In fact, they're reinvesting. They're doing massive reinvestments, and they're paying back their cash flows, which is why their present cash flows are just so terrible and are going to be terrible for the next few years. However, it will theoretically lead to some much larger cash flows eventually in the future. But that does have a pretty detrimental effect on the present value of their stock price. So anyway, coming down further, we can take a look at the returns on invested capital over this entire time frame. Much like with all the other profitability measures, we can see a precipitous change after 2018. Prior to 2018, their average returns on invested capital was 14.25%, and the returns on invested capital since then has averaged 3%, and that's including outlier years of both 2019 and 2020, If we discluded that, we end up with average about 2.5%. So returns on invested capital have completely been obliterated, as we were just talking about. But that has to do, like I said, with a huge amount of reinvestment in the business, and that reinvestment is coming in operating costs, as we talked about, which operating costs are going to be showing up here in the return on invested capital. So that's part of the reason it's like that, is that they're doing operating reinvestment, effectively speaking. Coming down to the returns on equity, how does that play itself into the leverage of their balance sheet? Prior to 2019, prior to the direct to consumer business, they had an average return on equity of about 19.5%, and the average since then has been about 3%. So huge precipitous drop, very similar to the returns on invested capital. Taking a look at the most recent 2 years being 2.5%. So you can see, effectively speaking, the leverage that they had over their returns on invested capital. They had average returns on the capital of 14%, and then average returns on equity of 19%. So they had gained about 5% worth of leverage effect, and then that leverage effect was basically completely obliterated during this time frame, which is basically destruction of retained earnings, is what that shows. So coming down to their balance sheet, we can take a look at the transformation of their balance sheet over time, and how has that affected the growth potential of their business. They have a huge amount of cash on hand relative to what they used to have in the past for the first 5-year period of their business. And prior to the direct consumer portion of the business, they averaged about $4 billion in cash on hand. Obviously, 2020 changed a lot of the dynamics and what people think about how much liquidity they want to have on hand at any given moment. They suddenly had about $18 billion in cash on hand, and that's been slowly being reinvested in their business. They're back down to $11.5 billion or so. I wouldn't be surprised to see that get cut in half or so over the next year as they weed that cash out of their business. But that's good for getting future returns on invested capital. You don't want the cash sitting there doing nothing. Accounts receivable has also grown pretty dramatically. However, is not at its peak levels. It actually peaked in receivables up in 2019 at about 15 billion, and then technically speaking, we've been on a little bit of a downward trend since then. So that downward trend has had a little bit of a bumpiness to it. Also, inventories themselves have also come up pretty significantly, but are also not at peak levels. The peak, again, occurred in 2019. And some of these peak levels in certain assets and liabilities in 2019 might have to do also with the acquisitions in 2018, and therefore when the balance sheet's fully formatted over. So this could have to do with some of the combinations of business and then them not fully reorganizing all those assets yet. So that's worth noting that that's going to have be the explanation for some of these factors. But inventory is peaking at 6.3 billion, and then they dropped their inventories pretty significantly in 2020, and then since then they actually dropped a little bit more, though it had a little bit of bumpiness to it upward in 2022 versus 2021, but it's still lower than it was in 2020, and significantly lower than it was in 2019, though still higher than it was in the first 5 to 6 years of their business. Property, plant, and equipment, we have not quite the same trend, whereas we could see that the actual gross number of property, plant, and equipment has basically just constantly moved up over time, which is what you would expect for such a large physical asset business such as an amusement park operator. Similar to the depreciation levels of their business, and we can see that the actual net value of said property, plant, and equipment has also basically continuously moved up over time. Pretty much every single year. Really, the only exception, it's not even an exception, it's just like the smallest level of growth that we saw was in 2022, 2021, where it actually only grew about 2% or so. But even so, significant growth in the overall the level of their assets over time. Now, the real king of the growth in terms of what part of their balance sheet has exploded over time has got to be the goodwill. Goodwill going from 27 billion in 2013 up to almost $78 billion worth of goodwill in 2022. Obviously, they're now starting to wheel some of that goodwill down by amortization costs, but that did come when they made those large acquisitions in 2018 into 2019. You can see it jumped from 31 billion up to 80 billion in that one particular year. So yeah, a huge portion of the assets on Disney's balance sheet is effectively just the brands that they've purchased, the different franchises that they have purchased. That's just the way that works. So coming down to the liabilities for the business, you can see that the current debt that they've had on hand has also not really particularly changed too much dramatically over time. The current debt that they had on hand jumped pretty precipitously in 2019 when they did take on the acquisitions, and then they kept a decent amount of that on hand throughout the liquidity scenarios of 2020. But then they've wheedled that down in 2022. So they've shifted most of their debt back into the longer term debt format. But that's not to say that the longer term debt wasn't very large to begin with. It was pretty much exploding pretty significantly throughout the entire time frame, going through from 12 to 13 billion, up pretty significantly even to just to 2018, up to 17 billion. And then that's when they took on the large acquisition, also through shares as well, but then up to 38 billion. And then that's up to 55 billion in 2020. and then that's come down a little bit since then, ending at 48 billion. So it is good to see that they've wheeled their debt down a little bit since the peaks in 2020. But that, and we also talked about how that's had an effect on the free cash flows of equity, because they have had to pay down significant amounts of cash flows. As we can see here, in the 2-year period, they paid down $7.1 billion, and then that $7.1 billion is, well, you can see it not quite exactly here, because it's also partially in the current debt levels, but effectively you can see that between the combinations between the two. Now, they've also had a pretty significant, I did kind of jump past a little bit, they had a significant increase in their accounts payable. Accounts payable has exploded from almost 5 billion, tripling to almost 15 billion by the end of 2022. This peaked in 2021, so it didn't quite have the same level of the dynamic where we saw that the receivables had peaked in 2019. So they've been whittling down their receivables a little bit more, while allowing their payables to actually continue to grow up a little bit since 2019, relatively speaking. But considering that they actually have more payables than receivables, and this gets us into the other side of the question, which I normally bring up when somebody is in that scenario, which is to say that you have to ask the question, well, is that put them in a negative scenario where that means that they're going to have to pay back their bills and they're going to have difficulty doing it? Or are they doing this intentionally because they see that as a way of financing more operations within their business? Now, I would argue that Disney, considering they're one of the most well-known brands on earth, is in a position to probably leverage that better for themselves than the average company. But it's worth noting which particular year in which that actually occurred. When did this changeover start to happen? For example, you can see that that actually did happen in 2020, where it went, their receivables had dropped from 15.4 billion in 2019 down to 12.7 billion in 2020, and then their receivables had payables had went from 13.7 billion up to 12.4 billion, or down to 12.4 billion. Which means it's 2020 is the point where suddenly they had more bills than they had bills to collect. You could argue that this is them making a strategic choice in 2022 to take advantage of their brand power in that sense, but you could also see that as them essentially borrowing against the future and eventually having to pay that back to get back on balance with their people. Give me just 1 second. Don't know why my cat refuses to just relax for my live stream, but he has to just mess with everything for some reason. Anyway, moving down the line, coming down to the shareholders' equity, taking a look at the total value of the shareholders' equity. The shareholders' equity was started at about 45 billion in 2013, and you can see that it was relatively flat and actually whittling downward into 2017, and then it did jump in 2018. So when they initially made their acquisition, it turns out that they did actually acquire a significant amount of shareholders' equity, which they did issue stock to do so. So it's pretty good that you would want to do that. You would want to get some equity out of the issuance of stock, and then that overall shareholders' equity exploded even more once the full consolidation of the balance sheets completed in 2019, up to 88 to 89 billion. So it looks like it's a huge explosion of shareholders' equity, but in some ways that's really just a function of the corporate working out there. But you can also see that the shareholders' equity dropped pretty significantly in 2019, which is not to be too shocking considering the losses that they would be taking in 2020. But then since then, it has continued to grow actually pretty quickly, going from 83 billion in 2020 up to 95 billion in 2022. So that's a pretty significant increase. And then you can also see that the retained earnings had somewhat of a similar pattern, where although except for retained earnings, you can see that they actually did grow a little bit up into 2017, 2018. But then alternatively, instead of the growth of the shareholders' equity, it was actually a decrease of the retained earnings. So effectively speaking, they got equity, but they paid for the equity with their earnings. So they paid for the acquisition with their earnings, so to speak. So the retained earnings dropped down to 42 billion, and then that's actually come down into 2020, which would make sense considering the losses they had there. And then they have managed to retain some earnings since then, which is good because that shows that they actually might be climbing out of the debt hole that they're in. So now coming down to the sales capital ratio to take a look at how that's changed over time. This gets into kind of the change in the overall content spend format of their business, as I was talking about, as they've changed towards a direct-to-consumer business, and how that means more of their expenses have turned into operating expenses relative to capital expenses, which is a little bit more traditionally how their business operated. As we had seen prior to the direct-to-consumer business, the sales capital ratio averaged for them at
in the kind of 0.8 to 0.83, which means that they would be getting about 83 cents for each dollar of capital invested in the business prior to the direct to consumer portion of their business. And then since they have started Disney Plus, their average sales capital ratio has actually been more like 49, which means 49 cents for each dollar of capital invested in the business. So that's a huge drop in overall revenue that you'd be getting for each dollar of capital invested in the business. Or alternatively, and what really happened here is they actually grew their sales, but the amount of capital that they have to invest is now just that much dramatically larger than it was previously. So with that, that's pretty much all of the historic data that we need to pay attention to make our projections for the future. Now we're going to come over here and I'm going to talk about the revenue model that I put together for the company, which is a little bit complicated to get into. What I did is I disaggregated all of the revenues for the last 10 years into the different segments of their business. Though, as I was kind of talking about at the start of the stream when I was going through some of their 10K information, I was complaining about how their segments have changed multiple times within the last few years. Over the last 4 years of their historic data, they've used 3 different setups of segments. And so I went through and then had to reset them all into a system that's consistent across the entire time frame so I can make projections for the future. So instead, what I did is I broke down all of the revenues for the last 10 years into networks, linear networks, direct to consumer Disney Plus, studios and other studio related content, parks and experiences, including both the parks, hotels, and cruises, and then consumer products and licenses, and then that also includes gaming and interactive stuff in some of the earlier years of their business as well. So this is the disaggregation of their business. Total revenues I have listed up here, and you can see that the total revenues, this is the year-over-year change, and then the 3-year compounded rate. So we can see up to 2018 and 2019, which is effectively prior to them doing much of Disney Plus, and then a little bit of Disney Plus has kind of started at the end of 2019, but not too much. You can see that the compounded rate of growth for their revenues had been at about 4% compounded clip, or maybe 8% compounded clip, depending on which particular year. You could take maybe the average between the two. You could say that they were growing at maybe 6% prior to Disney Plus. And then after Disney Plus has started, you can see that they grew 8%, 6%, 4%, 6%, and so you could look at that and you can say, oh, well, it's still growing at about 6%. So you could look at this on a kind of top-down level and say that their growth rate hasn't really changed too much since they started Disney Plus. Now, if we did break that down into some specific levels, you might have different ways of looking at that. Now, if we look at the networks, you can see the networks were growing at like a 2% compounded base prior to that, maybe 2%, depending on how you look at it. And then since then, it's actually grown a little bit faster. So since Disney Plus has started, networks has grown. I don't think that has to do with Disney Plus. I think that has to do with just how crazy the news has been in these last few years, maybe. I'm not sure. It's like maybe that's the reason why. But the point is there has been a little bit of pickup in networks, and that has been happening independent of the fact that Disney Plus has happened. Now down here, DTC, we have the actual Disney Plus revenues. You can see how dramatically that's growing at basically 50% clip for the first 2 years, and then a 20% clip in this most recent year. So very, very strong there. Studio content, we can see that was growing at about 11% compounded rate, or maybe 6% compounded rate, depending on which year you select. Maybe between the two, you can see an average of maybe 8% compounded over the period prior to Disney Plus. And then since then, you could say maybe that they've averaged about a negative 7% or so. So obviously from going from something like a positive 8% to a negative 7% shows that there's been a huge decline in studio revenues as the growth of Disney Plus has happened, which is what people typically talk about. They talk about the fact that Disney Plus is effectively them cannibalizing another section of their business. Now the question is just how much of it's going to be cannibalized. People won't probably not stop, people probably won't stop going to the movies entirely. But the question is, well, how much movies will they actually consume if they're going to be watching stuff at home? Now, we can see that the movies portion of their business peaked at about 11 billion back in 2019, and then that has dropped about 1/3 or so. Now, some people have estimated that it would be maybe about 1/3 of total movie industry would be destroyed. Some people have argued that it's more like 2/3 of the movie industry would be destroyed. But the point is, whether or not you think it's 1/3 or 2/3 or maybe the entire movie industry that's going to be destroyed, the point is even if it was if it was going to be 2/3 of the business that's destroyed, that's basically halfway there already, is what you could argue. Now, separating away from the kind of entertainment sections of the business, looking at the parks and experiences portion of the business, we can see that was growing at about 8 to 9% clip prior to Disney Plus. And then again, that is totally independent to Disney Plus. It has more to do with COVID. We can see that has then had a pretty rough time since then. During the COVID, it dropped 13%, down 21% thereafter, and then it was flat in the on a compounded basis since then. So the compounded basis since Disney Plus has happened, you can say it's down maybe 11%. Though, as we said, it's probably a little bit more independent of that particular feature, depending on which level you're looking at. Products and licenses, kind of similar story, that it's not really reliant on the DTC portion of the business. You can see that that's actually been relatively negative, kind of negative compounded basis prior to DTC, and kind of relatively flat since then. And you could chalk up the growth in revenue for products and licenses to inflation, probably. You could probably just say that they raised their prices, and that would maybe do a good job of explaining it. So anyway, taking these 5 segments and kind of then separating them out differently even further, we take the first 3 of them, the networks, the DTC, and the studio, and we basically count them all as the entertainment portion of their business. And that's what I have in this line right here, entertainment. Now, if you take a look at entertainment as a whole prior to DTC was growing at about 6 to 7% compounded, and entertainment as a whole since DTC has been growing at about 12%. So if you're going to say, well, is DTC destroying their entertainment business through the cannibalization process, or is the cannibalization process actually helping them to grow their entertainment business? This is where I would argue that they are actually effectively growing their entertainment business, because prior to DTC, they were growing entertainment at about 6 to 7%. And then since DTC, they've been growing it at about 12.5% per year again. So that's pretty good. Now, if you take entertainment and you subtract out DTC, so you see what the effect of the actual cannibalization is, then we have that right here. You can see that entertainment minus DTC was growing at about 3.5% prior to it. And then since then, it's grown at a little less than 2%. So the effect of the direct-to-consumer portion of their business has been to lower the movie and networks portion of their business on net down by 1.5% per year. They didn't actually destroy the growth. They just lowered the growth from 3.5% down to 2%. They cut the growth of the other portions of their entertainment business in half, but they didn't actually destroy the overall ability for it to grow. Now, again, that's counting movies and networks together. They're 2 totally different portions of the business. You could argue that they're not really all that related even, but I would argue that they both are being cannibalized by DTC though. So in my opinion, it is reasonable to consider it this way. And then either way, the point is entertainment as a whole is growing faster than it was previously. That's the key part I want to show here, is that it doesn't seem like Disney Plus has destroyed revenue for Disney at all. It looks like it has unabashedly, unequivocally grown revenue for Disney. You could argue about costs at that point. That's another question altogether. So now coming into, now that we've kind of nailed that question in, we've taken a look at how entertainment versus DTC or with DTC has been affected by the overall growth and which one has been cannibalizing the other. We can come down to take a look at my growth projections for the future. How are we actually going to think about where the revenues are going to go in the future? Now for that, I also do have the total subs for their overall DTC business right here. That's total subs, not just Disney Plus. It includes ESPN and Hotstar and all that, growing from 32 million here in 2019 up through to 235.7 million in the most recent year. Now we also have the D plus price, the US Disney Plus price. Now, as I was just saying, this is the total subs for all of their businesses. So you might be saying, well, why aren't you using the price for all their business? Well, the reason why is because I don't have the ability to get a weighted average price for all of their services. I can get a weighted average ARPU because they report that, but I'm talking about the sales price. I'm trying to figure out, like, what are they going to sell it for? And I'm going to assume that Disney Plus is going to be strongly correlated between the two. In fact, I'm going to improve that point here in a moment. So we have the D plus price as it first started at $6.99. It stayed at $6.99 throughout the next year. Then it was raised to $7.99. It's still $7.99. And then as I was starting at the start of the stream, in a month, it's going to be shooting up to $10.99. And then I have future projections beyond that. Now the monthly ARPU is the number that's reported as their. This isn't the number that they report in the earnings release. This is an effective ARPU that I've calculated by basically taking the DTC revenues as they report here, dividing it by the total amount of subs, and then dividing it by 12 months, which would give us the monthly number. So you can see that the ARPU was like $19 or so at the very start of the business, which reflects the fact that the majority of their subs at the start of the business was Hulu, which Hulu has a much higher ARPU. And then you can see that as Disney Plus started to actually become the main portion of the actual business, the ARPU was $7.50 for the next year. It went up to $7.60 with the growth of the Disney Plus price in the next year. And then because Disney Plus did not increase the price in the year after that, you can see that in this most recent year, ARPU has dropped down to $6.91. Now, if you take a ratio between the price of Disney Plus and the ARPU, you can see that it wasn't very well connected for the first year, as I was kind of talking about. And then they were very well connected in the next year. And then now you can see that it's a little bit lower than that, as I was just talking about, partially because the global portion of their business isn't taking the same price as Disney Plus. But either way, this ratio between the D Plus price and the ARPU price of 87% is going to be the ratio I'm going to use between the two, assuming that effectively the portion and between the ARPU of Disney Plus and the ARPU of global won't change too much from where it currently is in the future, is what my assumption is. So with that, we have future assumptions. I'm assuming I'm making some totally random assumptions here about Disney Plus price. You can disagree with me about what you think is going to happen with that. This is just me kind of spitballing my assumptions. I'm assuming that they like I said, they're going to raise the price to $10.99 this year. Then I'm assuming that next year they're not going to raise their price. And the reason I'm assuming that is because $10.99 is a pretty big increase in price. And then the last time they increased the price, they didn't do it the year after that. And then this is an even bigger one. So I think that they probably can't afford to do it in the year after that, but they might be able to pull it off again after that. However, they might go down to a smaller increase because they may decide that this was too large of an increase last time. So I'm just this is, like I said, I'm just randomly coming up with these assumptions. I'm assuming this can be $10.99 this year, $10.99 the next year after that, $11.99 the year after that, and then I'm assuming that they will be able to increase the price by $1 per month for each of the years after that. This is my best case assumption. That's what I make this clear. This particular line is the best case assumption for the D Plus price in 2027. Is that I'm assuming it'll be $13.99 per month for Disney Plus in the United States. Now, if I take that ratio, like I said, I'm assuming that the overall ARPU will be about 87% of what that price is. So that means my best case scenario assumes that the ARPU that they'll be receiving is about $12.11 overall in the 2027. And then sub growth, that's going to be the next portion of the assumption we have to make an assumption about. I'm going to assume that sub growth is going to grow at 13% per year. Now you're probably wondering, well, where did you come up with that number? Well, frankly, I worked backwards. I said that in my best case scenario, this is a best case scenario, I'm going to assume that effectively speaking, they're going to have every person in the United States as their sub, plus about 1% of the rest of the globe's population, which equals about 430 million people. So that's kind of what I put there. Now you're probably like, everybody in the United States plus 1% everywhere else? Well, it could be 50% of the United States and 2% of everywhere else for all I care. It doesn't matter where the people come from. This is just a random assumption I'm doing it off of. They currently have 235 million subs, and about 3/4 of those, or 2/3 to 3/4 of those, can effectively be said to be in the United States, which means in a certain sense, they're already about 50% of the United States. Is pretty close to where they're already at. So me assuming that is, like I said, it doesn't mean that they're actually going to be in the United States. It's just kind of a best case assumption. Now, my worst case assumption is somewhat similarly figured out, where instead of saying it's going to be all of the United States and 2% of the world, it's assuming it's going to be 50% of the United States and 1% of the world. And that gets you to 300 million. So 430 million is my best case scenario for subs of 2027, and 300 million is my worst case scenario for subs. Again, they're currently at 235 million. So that's what we're basing this off of. So with that ARPU and those subs, that gets me to DTC revenues in the best case scenario of 63 million in 2027, and worst case scenario 37 million in 2027. Now I also have projections for the non-DTC portion of entertainment, which is the studios and the linear networks portion of the business. For that, I'm combining them together, and in the best case scenario, I'm going to assume that it just doesn't grow, but it also doesn't shrink. That's the point, is I'm going to assume that DTC manages to grow in the best case scenario without actually shrinking any more of the overall combined level of networks and studios. That's my best case scenario, which means that they'll still have $35 billion in revenues in 2027. In the worst case scenario, I'm going to assume that it decreases at the same rate that the subs of DTC are growing, which is 13% per year. That's kind of an arbitrary assumption, but it's tying it together. It's basically saying that in the worst case scenario, there's going to be a pretty close relationship between the loss of revenue and the growth of Disney Plus. So that's my worst case scenario for that, which means the worst case scenario networks and studios revenues ends up being about 18 billion in 2027. So if we combine our our GTC revenues plus our entertainment revenues, we end up with a best case scenario for entertainment of $98 billion and a worst case scenario of $55 billion. Then we have to add on parks and products, which is the other two portions of our business. For our 10-year treasury, we currently have about a 3.5% interest rate, which is a good proxy for the nominal growth of GDP over the next 10 years. I'm going to just do a pretty broad assumption where I'm going to assume in the best case scenario, parks can grow twice as fast as the economy. In the worst case scenario, I'm going to assume that they don't grow at all. It's a pretty simplistic estimate for parks and recs. Parks and experiences, but as I said, parks and experiences is only 25% of their business, so it's fine. We can use a pretty simple method for that. But that gives me about 30 to 31 billion in the best case scenario to 21 to 22 billion in the worst case scenario. Now for products and licenses, we're also going to be using basically the same method, except we're not going to do it twice as good as the economy or zero. We're going to do it as just as good as the economy in the best case scenario, or negative the growth rate of the economy in the worst case scenario. Because as we saw a decent amount of negative product growth, having to do partially with, I think, less interest in consumer products licensing directly through Disney, and instead third-party people taking on those options. It's just the less focused portion of the business. But that gets them 6.2 billion in the best case scenario and 4.3 billion in the worst case scenario. If I add up all these segments together, we end up with best case scenario revenues for Disney as a whole of 135 billion in 2027. In the worst case scenario, we get 81 billion. So these are going to be my future projections for revenue for Disney. It's a pretty sophisticated model, I'd say. We built it all up, ground up, basically, trying to build up their overall revenues, and that's what we end up with. So with that, we can actually input all of our projections for the future. I will say, if you're watching now live or on the replay, please give us a like. Please like the video. That way you can help attract more viewers to the channel. And if you have already liked the video, please subscribe to the channel. It'll help attract more viewers to the channel. That way we can grow our community even more. GT, hey, what's going on? Welcome to the chat. Also, if you've already done both of those things, please consider joining the Discord. The first and pinned comment in the chat is the link to the Discord. You can join that to become part of the discussion, where we release news articles related to daily news, have discussions about what's going on in the markets and in our own portfolios, release articles related to company analysis or other major investors and things like that. So come be part of the discussion there. So as I just said, our worst case scenario revenues for Disney, we basically saw as basically about 81 billion, and best case scenario, we see about 135 billion. I basically put those numbers in here by putting in the growth rates that gets us closest to that. I do have the short-term revenues for Disney taking a small hit in my scenario here. That's not really all that meaningful because of the fact that we're going towards the long term, but effectively I'm assuming that there could be perhaps a little bit of a small hit to the revenues in the short term as some of the other portions of their business get cannibalized, front loaded a little bit. But in the long term, we're seeing it getting to 82 billion and 138 billion, which is give or take our estimates from our model, and that gets us an expected revenue of 111 billion dollars. Though that expected revenue is also based off of our weighting that we've done here. I have significantly weighted more towards the more optimistic fourth model compared to the second model. I gave it twice as much weighting actually. So I am relatively optimistic on these assumptions. That's something that has to be taken into account. It's like with these projections, I'm actually assuming a relatively optimistic scenario. I'm assuming it's much more likely that they will lean towards that 100 billion mark, much or higher than 100 billion mark, much more than sub-billion, 100 billion mark. Anyway, coming down to the margins, this is where things get a little bit tricky. As I was talking about in the earlier portions of our business, we can see substantial change in their margins since they started the DTC portion of their business. If we look at 2018 prior to that, their average margins, the net margins was 16%, while their average operating margins, one year off, while their average operating margins was 24%, while their average gross margins was 45%. So they had huge gross margins from 45% that then dropped down to an average in the most recent 2 years of 34%. So that's like an 11% drop in gross margins. And then average operating margin has been 6 to 7% versus again about 24%. So that's like 19% drop in operating margins. And then the average net margin has been like 3% versus again like 15%. So it's like a 12% drop in net margin. So it's like all across the board, net margins have been destroyed by the DTC business. And then the question is well, just how much of those margins are they going to come back? Now, I made some pretty rough assumptions here. It's worth noting, again, as we talked about, the long-term margin of the entertainment business seems to be about 10% or so. So you could just go with a kind of a 10% assumption, but I kind of wanted to take a look at some ways of thinking about just how much of this could they get back. And like, for example, we saw the average margin prior to DTC is 45%. The average in the most recent 3 years has been 33%. If you take the difference, that ends up being 12%. Maybe if we just assume that they get half of that back, let's just assume that they get half of that back. So 6%, we add 6% onto the existing net margin that they have of 3.8%. And then we also add back possibly half of the interest rate that they've increased since then, because they used to spend about 1% of their sales on interest costs. And now in the most recent year, they've actually spent about 2% of their sales on interest costs, not their debt, not their interest rate, the percent interest of sales, which means it's like 1% of their margin has disappeared into interest. And again, they took on a huge amount of debt in order to do DTC. So that's why I'm talking about this. So it's like, let's assume that they get half of their gross margins back. And let's assume that relative to their sales, they either grow their sales or shrink their debt about 1%, so that they get about 1% of that back. Overall, that means that they could increase their margins by about 7% or so comparative to where they're currently at. And then the 7% plus 3.8% gets us about 10.75%. So there you go. There's one way in which you could argue that maybe they could get close to 11% margins. As we had said, their industry seems to show that maybe about 9.5 to 10% margins. You could argue about how you want. 10.5% is the midpoint of the margins I'm going to rely on here. I have it leaning towards 11.5% because, like I said, I'm being a little bit more optimistic towards them because I'm going to lean it towards 12%. So pretty simplistically, I'm just giving them a range of 5 to 16%. You might be like, well, why 16%, not 15%? Again, I was trying to give it a little bit more of an optimistic tilt. That's partially just my own bias towards the brand, I guess you could say. Now, with that gets to the next most complicated question of just how much capital expenditures do we assume that they're going to need. That gets into the assumptions as I was kind of making about their kind of longer term average capital expenditures and that they've seemed to have done in the past. I had come up with the assumption that if you include capital expenditures, depreciation, as well as working capital and acquisitions all together into one number, then you end up with an average over kind of long term of about 3.3 billion spent on any given period or any given time. However, if you then make those assumptions, if you then change those assumptions to include to separate out the amount of acquisitions, you find out the acquisitions have effectively been like 300 million per year. And so you could say that reinvestment would be something like 3 to 4 billion per year. Now that compares to, again, the cash capital expenditures that they said that they're going to do this next year of 6.7 billion, and 6.7 billion, they had amortization in the most recent year of 5.1 billion. So if you subtract out the two there, that means you would have net capital expenditures of about 2.5 billion. And then they also had working capitals. They've had consistently positive working capitals in general. So maybe if you had 1 or 2 billion there, you would end up with like 3 to 4 billion in net reinvestment in the next year or so. The problem with that is that if we actually give them that type of level of reinvestment, it effectively makes their sales to capital ratio even lower than would be reasonable to accept, which is what I was kind of talking about earlier. There's a little bit of some discrepancy between what they say they're going to do versus what it seems likely they're going to do. So while they say they're going to do a huge amount of cash capital expenditures, I do actually think it's possible that they will either not do as much cash capital expenditures as they say they're going to do, or B, they're actually going to liquidate a significant portion of their working capital in the near term future. So effectively speaking, I'm going to give them a little bit of an extra benefit of the doubt in the sales capital ratio by assuming that their sales capital ratio is going to go much closer to where it used to be prior to DTC. Their average sales capital ratio was like 85 cents for each dollar capital invested in the business, whereas in the most recent few years, it's been more like 50 cents for each dollar capital invested in the business. I'm going to allow their sales to capital ratio to actually grow pretty significantly back up closer to like 75 cents for each dollar capital in business, which is giving them a pretty big significant benefit of the doubt. It basically means that a lot of their capital expenditures will be effectively immediately amortized over the next few years. And that does give them a huge boost to their business, but I actually think it's somewhat reasonable to do because of the way that they've been front loading their content creation for the platform. So with that all we need is a debt to equity ratio, which their current debt to equity ratio is about 30 to 31%. And considering I find them to be significantly overvalued, I assume automatically that their debt to equity ratio would have to increase with the adjustment of their market cap. So that means that if they just came back down to fair value, their debt to equity ratio would be more like 40 to 45%. So with that, we have to assume that the debt to equity ratio would go up, even if they paid down their debt, which I do think that they will likely pay down some of their debt. So we probably won't bring it all the way up to 40 to 45%, but I will have it lean towards 75% and 55% on the scale of it to get us close to that assumption. So with that brings us to the overall summary for Disney with all these assumptions in place. I'll ask one more time, if you're watching live or on the replay, please give us a like. Likes help attract more viewers to the channel, and it's the #1 way that you can thank me for the work that I do here. If you have done that, please subscribe to the channel. If you have already subscribed to the channel, please consider joining the Discord, the pinned comment, and it's in the description below. Also, as I had mentioned at the start of the stream, we are planning to do an extra stream tomorrow at 11:45 a.m. Arizona time, or 1:45 p.m. Eastern Standard Time, in order to be part of the Federal Reserve's announcement of monetary policy decisions and Jerome Powell's meeting and press conference thereafter. So come and join us and be part of that live stream tomorrow, a little bit of a hangout stream to discuss that. So DIS, Walt Disney Company. As I've said, it's one of the most well-known companies in the world. Does have a pretty bad value problem, it does appear, though. So mature market equity risk premium is currently about 5.5%. 10-year treasury currently selling for 3.6%. Discount rate that I come up to for Disney after adjusting for company specific and idiosyncratic risks, I end up with about 11.67%. They currently do not pay a cash dividend of any kind, nor do they have share buybacks authorized. 5 years ago, they had sales of $55.1 billion, and in the most recent year that they just finished, they had $82.7 billion in sales, which equates to sales growth of 8.45% per year. Sales capital ratio they currently have is 0.56. Again, that's 56 cents in revenue for each dollar of capital invested in the business, and that compares to the entertainment industry as a whole, which has a sales capital ratio of $1.32 in revenue for each dollar of capital invested in the business. Returns on invested capital in the most recent year period is been about 9.8%, which is a little bit higher than the cost capital that we found. We found the cost capital to be about 9%. So it shows that at least in the most recent history over the last few years, on average, they have managed to still achieve returns higher than their cost of capital. However, that's not going to be necessarily the case for the future projections, which I'll show here in a moment. The debt to equity ratio they come up with, or that they currently have, is about 31%. And they basically have no real default risk in the most recent year period accordingly with that debt. Profit margins is currently 3.8%, which is a little bit of an outlier due to the higher content spend that they had in the most 3-year period, although obviously that's assuming that they're going to climb back out of it. As you can see here, the average for the entertainment industry as a whole is a little over 9%. Their current profit is $3.1 billion, and they're currently selling for $94.70 per share. The probability distribution that I'm using for my valuation assumptions is actually pretty optimistic. We're weighting much more heavily into the fourth case optimistic model. It's actually twice as heavily weighted in the fourth model as it is in the second model, which only has 15% of the probability versus 30% of the probability, so it's a significant tilting from our more standard normal distribution that we use. But either way, that gives us a revenue distribution of anywhere from $82.8 billion in revenue in the worst case scenario to possibly $138.3 billion in the best case scenario. On expected basis, we see $111.6 billion, which equates to sales growth of anywhere from basically no growth to possibly close to 11% per year. On expected basis, we see about 6% per year. On a sales capital ratio, on expected basis, we see about 77 cents in revenue for each dollar of capital invested in the business, which, as I said before, basically assumes that they're going to climb back to about halfway to the profit, to the capital efficiency that they had prior to starting Disney Plus. Returns on invested capital, we see them on an expected basis at about 8.85%, which is just barely below their cost of capital, which is a little disappointing to see. It means that, effectively speaking, despite all these efforts, they're not actually going to earn their cost of capital, which means, effectively speaking, that value destruction occurred. Not really what you like to see. You want to see a company trying to earn above their cost of capital or not bother growing in the first place. Debt to equity ratio, we see it growing pretty significantly up to 48%. As I was kind of talking about just a moment ago, if we have a debt to equity, If we have a debt to equity ratio of about 31% and we see the company as possibly decreasing in value by like 30 to 35%, it comes down almost a third of its value, well then just inherently you're going to see the debt to equity ratio jump up pretty precipitously. So we see the debt to equity ratio climbing up to possibly about 48% on an expected basis. With that debt level, we do see about 1% per year in default risk, which is a little bit high, but not necessarily too high. It's a manageable level of default risk overall. And profit margins, we have a distribution of anywhere from 5% to 16%. On expected basis, we see about 11.5%, which gives us a profit distribution of anywhere from $4.1 billion in the worst case scenario to possibly $22.1 billion in the best case scenario. On expected basis, that gets us an assumption of about $12.8 billion in profit. Now we also have a present value distributed expectation based off of the discount rate that we've used across the varying sets of assumptions of about $60.21 per share, which is 36% lower than the current share price. Now we have 5-year forward value targets unadjusted for the dividends that they could eventually pay out to the shareholder of anywhere from $29.72 in the worst case scenario to possibly $198.62 in the best case scenario. On an expected basis, that gets us a price of $104.56 per share, or I should say a value, not a price, of $104.56 per share, which compared to the current share price gets us an implied return of 2% per year. So yeah, very, very poor expectations to be had for Disney on a valuation basis, not on an operating basis. On an operating basis, I would say that they're doing pretty good. There's a whole lot of talk about how Disney is destroying its own brand or whatever, or how the cannibalization process isn't going well for them, or how they're going to be eaten alive by all the costs and they're not going to be able to get the costs under control, or how their debt levels are too out of control or whatever, or, whatever negative headline you might have for Disney. But like I said, my analysis of them on kind of a segment level and kind of like grouping those segments separately and thinking about them and analyzing them separately in that way has kind of made me believe that this whole Disney Plus direct to consumer process is actually going really well for them, I would say overall. It just their stock price is just too high. And you know what? Stock price doesn't necessarily always have anything to do with operations. Sometimes the stock just gets way ahead of itself. So that's just, I think, the scenario for Disney as it stands today. So that's going to do it for today. That completes our evaluation of Disney. As I said a couple times already in the stream, we are planning to do another stream tomorrow at 11:45 Arizona time, 1:45 p.m. Eastern time, in order to go over the FOMC announcement and also listen to Jerome Powell's conference and, just hang out and discuss tickers and things like that, so that you can look forward to that tomorrow. And please come and join us and be part of that little hangout tomorrow. It'll be real fun. And then also, obviously, I'm preparing for my next valuation, which will be next Tuesday, which based off of the poll results that we've been doing on the channel, because we've been doing polls on the community tab of the channel to decide which valuation I'll be doing each week. If I assume based off of the second most votes from last week, then I would say that it's pretty likely we'll be doing Skyworks next week. I do have that valuation basically good and done and ready to go. However, there is a community tab where we put a poll out each week. So tomorrow I'll be putting that poll out and you can go and vote for which company you want me to do next week. So that's going to do it for our stream today. Thank you for those who were here, liked the stream. I see a few handful of likes there. I appreciate that. If you're watching now live or on the replay, please, one last time, please give us a like. It's the best way you can thank me for what I do here. And if you haven't already, please subscribe to the channel. It is the best way to make sure that you get a notification when I go live or when I release other content like this. And then one last time, go ahead and join that Discord. The link is in the description below. All right, I'll catch you all again next time.